you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
Hello and welcome to the Morningstar Investment Conference in Europe. I'm Emma Wall and here with me today is Daniel Needham, Chief Investment Officer for Morningstar. Hi Daniel.
Hi Emma.
So why is valuation important to be a successful investor?
I think valuation is important because it has such an impact on the returns that you get from owning assets and asset classes. And so Warren Buffett's got a great quote: "Price is what you pay and value is what you get." And I think when you think about an asset, normally what you're buying is a series of cash flows to be received in the future. And so the return comes from those cash flows. But if you overpay for those cash flows, then what that means is that you're likely to see much lower returns than what you would get from the cash flows themselves. And so we think valuation influences individual companies, it influences bonds, individual bonds, it influences asset classes, and so we think of valuation-driven investing as much as a philosophy as an approach.
And we've just heard you speak at the Morningstar Investment Conference in Europe, and you showed this fantastic graph which shows that if you take a value approach, you outperform one that is sort of equally weighted. However, you also made the very pertinent point, which is backward looking is not always an indicator of what happens in the future. If we have a look at the US stock market, last 5 years have been fantastic. That's not necessarily what's going to happen in the next 5 years, though. That's right. So there's 2 points to your question. The first point is that when looking back through time to assess what we think fair value is, we know what happened. We have history and hindsight on our side, and so hindsight makes prediction a lot easier than, and that's why I guess foresight is so difficult. So on the first point, so you can go back and assess what you should have done, but that's very different to what you would have done because you don't know what happened. And so what we've tried to do within the presentation was look at what somebody could have produced, or how one may have invested with the information that they only had at the time, and showed that you can actually produce superior returns than a static portfolio. But again, it's with the benefit of hindsight. The more important point I think out of that one is less about the fact that the strategy did better. It's more that to take advantage of the opportunity required investors to do things that would have been very difficult at the time. That is, not holding US stocks in the late 90s. Incredibly difficult thing for anybody to do, even very experienced equity managers. So that's one of the key points. And then the second point is looking at equities in the last 5 years. Effectively would be extrapolating those returns, which is probably the most dangerous behavior that any investor can partake in. That's one of the good things about valuation-driven investing, is that when you've had a good 5-year period, the valuation gets high, assuming that the returns have outstripped the cash flows, such that the prospective return will actually be lower. And that's the case, I believe, at the moment within the United States, at least based off our guess of the future. And you touched on it then, though. You said that if you've followed the value approach, there were 51 months in the run-up to the tech bubble bursting where you would have had to not hold US equities, which would have probably got you sacked or dumped by the private investor. So what can retail investors do to sort of take those blinkers off and not be herded with the crowd?
That's right. Well, this is one of the let's call it the dirty little secrets of asset management, is that individual investors have a huge advantage over institutional investors, and it's something that Warren Buffett calls the institutional imperative, and Seth Klarman calls the short-term relative performance derby. Institutional investors have to perform over a short period of time, and being different to the crowd and underperforming can mean that you can be fired. And so the research that I did was more to illustrate the fact that to really take advantage of the strategy in a kind of let's call it a theoretical way, you would have had to have been out of US stocks for over 50 months. And that would have been being out in about early 96 and not getting back in until 2001, which for an institutional investor is effectively just not possible. For an individual investor, that is possible.
And looking then at the market now, just using the value concept, where are the best opportunities?
Well, I mean, I think that equities overall are overpriced, but within equities, I think there are places that still look relatively attractive. And but it's fair to say this is not a fantastic investment environment on a prospective basis. I think generally asset prices have risen a lot everywhere. Generally, bond yields are low, cash rates are zero. Arguably, that's been engineered by the central banks. So right now, most asset markets are priced to give you low returns. And so I don't think that's actually a brave forecast. I think that's actually probably a reasonable prediction of what will happen. So what that means is that investors probably have to hold an unconventional portfolio. So probably, the opportunities are in European equities or Japanese equities and emerging market equities, and probably in emerging market bonds and places where many people are maybe more concerned. And so effectively, when investors invest for safety, that the cost of safety often comes at the realization of low returns. And so where investors are avoiding, that often means that whilst they are risky, you can get a better return if other investors are not willing to buy.
Daniel, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.